in the original book, I talk about this thing called the four forces of cash flow. And so after I developed the return on invested capital concept, I needed to revise this because I'd originally talked about reinvesting in the business as part of this taking dividends and making distributions, and I felt like I really needed to move it up to the top of the list because here's the deal. 99% of the things that you're going to reinvest in your business are deductible. They are the things that I'm going to spend more money in marketing. I'm going to add a person who I'm going to take a risk on and see if they can develop. I'm going to buy a piece of equipment. Oh, by the way, I take Section 179, first year expensing depreciation. And so almost everything that you spend to grow your business is a deduction in the year that you spend it. So guess what? In the order of priorities, for me to estimate your tax liability, I got to know what you've reinvested. So that's why I have to move it to the top of the list. And I believe strategically, it should be your first decision of what you use profits for as well. Because I've proven to you the argument. Does anybody disagree with me that your business can produce a 50% or better return on investment year in and year out? Have I won that argument? Because I'm telling you it's actually closer to 75 to 100 for most of you. Right? So, once we decide what you're going to reinvest, then we can calculate your quarterly tax liability. The biggest issue with taxes is the fact that getting a return done is a commodity for the most part. Yeah, there's going to be some variations, but at the end of the day, most firms are going to be pretty close. The price might vary a little bit. It's not going to vary a lot because we see a lot of this data. And it's like, at the end of the day, it's more about you engaging with your tax professional to give you a number of what should you set aside this quarter for what actually happened, not the safe harbor payment. You can get whacked on both ends using safe harbor. If this year is more profitable than last year, safe harbor is going to get me in trouble because yes, I've sent the money in, but I didn't set aside that difference that's going to go in next April 15th. And you're going to be behind the 8 ball next year because you've then taken distributions and wasted money personally that you should have saved for taxes. On the other end, this year's lower than last year. They're having you make safe harbor estimated payments. What does that do? Uses up precious working capital that you've given to the IRS that you can't get back until you file a stinking tax return. That's dumb. That's lazy by our profession. And I'll challenge anybody in our profession that you got to do better. You got to make this something that's not so expensive to do to serve your clients to where you give them a good enough calculation of what it actually is to then base those decisions off of. It's not rocket science, folks. This is pretty straightforward. And so that's a huge deal. Almost every client we have today, we have them set aside a separate tax savings account. So every quarter, what you actually owe goes into that tax savings account. When we tell you the least amount to send in without incurring a penalty, it comes out of that account. So once you put it over there, it doesn't affect operations. You now have a clean sight line of what money is yours and what money belongs to the IRS that you're still just getting to hold on to. Because if next quarter you have a loss, I don't want you having sent it in because I want to reach over to that tax savings account and pull it back into operations. Because I can't go file a return to get it back. So that's just cash management 101 that has to happen. Right? Once you're there, now I know how much money I have to repay any line of credit debt if I have it. So 100% goes back to that line. And then you're going to kind of work off of essentially whether you have, I'm not a huge fan of automatic payments back and forth against the lines. Zero balance accounts were a fun thing back in the day, but I'm not a fan of them now. I want you to set your cash position once a week. Pay down, draw back, pay down, draw back, but do it once a week in that process. And then essentially you get this to zero, and then the next thing is you keep your hand out of the distribution cookie jar until you get 2 months of operating expenses which means direct labor and all your operating expenses, everything you don't get terms on. Because you have to count labor. Because unless you guys have figured it out, I haven't figured out a way to get terms on my labor yet. So, and if you guys figure that out, let me know. So I got to count that. Then, if I have money left over, then I can take a dividend. I can take a distribution. Straightforward, right? So, let's talk about business models. There's only 3 business models that exist in the world. You either do stuff, you sell stuff, or you make stuff. Anybody get left out? That's it. Quit thinking about what industry you're in. Do you do stuff, do you sell stuff, or do you make stuff? Now you might do a combo of the two. Guess what? They're 2 different businesses. If you make stuff and you sell the stuff you make, I got news for you. You're 2 different businesses. You need to be evaluating the efficiency of the group that makes the stuff, and you need to be evaluating the efficiency of the people that sell the stuff. And if you suck at making it and you're really good at selling it, get somebody else to make it. And if you're good at making it and you're not good at selling it, get somebody else to sell it. That's the whole reason why distributors and all those kind of things. Now, granted, I like to control what I sell, but sometimes people just aren't good at that, and so you gotta look at those. So, 3 examples. You're gonna get a test on this, so pay close attention. So, the make business, $4.4 million of revenue. Are they really a $4.4 million business? What are they? They're a 2 point, exactly. Very astute. Gross margin, revenue minus cost of goods sold that do not include labor. In our data, gross margin never includes labor. It can include subcontractors where you've subcontracted with a company outside. I'm not trying to be IRS compliant with our term of our direct labor. You might hire freelancers, people that are essentially hourly workers or something like that. Be careful with that. There's a lot of compliance issues, and still to this day they are. But at the end of the day, if I'm a construction contractor and I hire a sub to go do something, they're part of cost of goods sold. So gross margin is the true economic top line of your business. So whoever said that, that manufacturer is a $2.6 million assembler of stuff is what they are. They're not a $4.4 million business. So if you go look through the Inc. 5000 list, you'll see a lot of fakers. A lot. And there's a lot of companies on there that just manufacture that revenue that isn't real. Gross margin, I'll tell the chapter when you guys are evaluating new members, you need to somehow get their financial data and get to a gross margin number, because that tells you whether or not they truly are a qualifying member. And if I could get the accurate data, I would establish $1 million of gross margin as the absolute minimum EO member, not $1 million of revenue. Because we've all dealt with non-peerness with people who had $1 million of revenue. We had this one client had $1 million of revenue at a 10% margin, and his sole goal was try to get to be an EO member. And we said, and his business had no chance of succeeding. And so we only did a project with him and decided we didn't need to do any ongoing work because this was not going to work. He thought he was $1 million business. No, he was a $100,000 business and losing money at that. Okay, the percentage of gross margin is not as relevant. It can be used for some things, but it's more about dollars right here. You can get tied into a percentage, but it's really about producing a dollar gross margin. The next thing is direct labor. These are the people that spend 50% or more of their time doing the thing that you do. This is just labor. It's not the payroll taxes. We like to keep payroll taxes and benefits. I'm not a fan of loading because it creates unnecessary, worthless accounting effort, that paying a human to do something that doesn't produce any value. The labor efficiency ratio that we talk about here, the 289, which is 2.6 million divided by 900,000 on this line, the DLER, that has the payroll tax leverage built into it, so you don't need to spread it around. And when you take costs and start spreading them around, you lose control of them. So I want to keep cost in their home. That way I can keep an eye on them. If I keep payroll taxes and benefits in its own bucket, I can tell, are they going up relative to all labor? Are they going down relative to all labor? And if I take them and spread them around like peanut butter, I forget that they used to be a peanut, and I lose track of them. Okay? Then you've got, these are the 5 functional categories. So here's what I learned. They lied to us in accounting school. So they tried to tell us about this thing called fixed and variable cost. Everybody familiar with that? I got news for you. In the real world, there's no such thing. There is no cost that's fixed and no cost that's truly variable. They all are a hybrid. So quit trying to deal with fixed and variable cost. Deal with functional cost. This whole P&L is structured based on functionality. So what does each function do? And each element has some element of variable and fixed, but because they're based on function, you can actually do an interpretation to say, facilities is going to be fixed up to a point of capacity, and then it's going to either move up or down based on the size of the business, or when my lease runs out, or when I get to a certain size and I run out of seats for people, and those things. Marketing is a purely discretionary cost. As the old adage goes, half of my marketing's not working, I just don't know which half. So we have some interesting strategies, and we'll show you the case study here in a second about marketing spend. Most of you do not spend enough in marketing. I'll tell you, 90% of our clients are not spending enough in marketing, and of those 10% that do spend enough aren't spending it effectively. So we've tried to develop some new techniques to give you some monitoring of effectiveness. I can't tell you what to do in marketing. That's what the marketing professionals are for, but I can darn sure keep score. And so I think that's really kind of where we've helped some people in that concept of looking at, most of the time, what we really like as a metric is looking at marketing on a rolling 12 basis as a measure, in its numerator's contribution margin. So we look at contribution margin dollars per marketing dollar spent to say, am I getting more effective in my marketing outcome? Am I getting less effective? It'll be some temporary, but if I'm using longer time frames, I'm going to get better insight as to, months are kind of jumpy. Although in today's world, pretty much if you don't get response in a month's worth of marketing spend, it's not ever going to happen. There's not a lot of long-term marketing spend anymore in that process. Management labor, anybody who's not direct, they're going to go here. We used to call this admin labor, but the managers kind of complained and they were whiny about their ego, so they didn't like being called admin, so I changed it to management. And then the great collect-all is other operating expenses. This is the catch-all bucket of anything that didn't fit in one of those other functional categories. So it is the great noise of business. It's going to have the greatest line items in your P&L. And it's going to be like this on a rolling 12 basis. Now monthly, it's doing this. On a rolling 12 basis, it's smooth as a baby's bottom. And you're not going to go find success, and it's the natural inclination for every one of you that when you struggle with profitability, you're going to go beat up the office supplies number. That is not, if you go to one-ply toilet paper, you're just going to aggravate everybody. So this is not where it happens. Other than some overpriced consultants who go in that category, that's the only number that I've seen that people needed to do something about.
What about technology?
Depending on the technology itself, it would probably be usually facilities. So like software infrastructure expenses that you use for operating your business, we actually consider that facilities. So that's infrastructure. So facilities to us is rent, utilities, IT, telecommunications, all of those things. Now, if you are developing software, we put that down here as a launch capital tracking mechanism to say, hey, what are we spending on this and when are we going to make it operational and are we going to get a return on it, that process, okay? So we walk this down, management labor efficiency. So direct labor is being held accountable to gross margin. Management labor is held accountable to contribution margin. I will tell you, the number one key of labor efficiency is if you can make your management labor effective, your business will be profitable. Management labor is responsible to drive revenue, control direct costs, control direct labor. It's got 3 balancing characteristics it's got to deal with. Direct labor just has to be efficient with the gross margin that's put in front of them and not be wasteful. And guess who leads them? Management labor. So you can blame the direct labor all you want. It really comes down to management. And this strikes fear in the hearts of management teams when we start talking about management labor efficiency and start tracking that for a company. Are you getting better or are you getting worse? And when we see a negative management labor trend, there are some squirmy seats going on in that call of management people going, yeah, I need to get Fred to be a little more focused and not drive the tracker off the cliff, and make those things happen. Now, same thing here, we've added net operating income. So this is from operations. This number would be close to EBITDA. I'm not a fan of the term EBITDA, so we call it net operating income, but essentially this would be pretty close to that number. And we look at it two ways, as a percent of sales and as a percent of gross margin. And then things that are non-operational, traditionally interest income, depreciation. This reinvestment expenses, this is a line item that we'll put down that is where you're spending money. So like the launch capital concept that we'll talk about here in a minute, this is where we'll track things like if you are spending money on a software development, if you are spending money on a marketing campaign that hasn't launched yet, it gives us a clean sight line of what your true operational net income is of normal operations, and then this is that thing that we're spending profits on, but it's not in service yet in that process. So then we get to net income the same way. Selling business, you can see 13% gross margin. Woo! Anybody have a 13% gross margin in your business? Now, notice that they actually make $1.2 million in net income, 3% net operating in 3.68 net operating income, 3.1 net income number. That business today is over $100 million, but still at 13% gross margin. But still a great business, but you'll come to figure out why. The services business, you can see very little COGS. That $500,000 represents just some outsourced work. So much lower LER, so a 2 direct LER. 12% profitability, but still only 12%. So notice between these three, 26.69 profit to gross margin, 27.48 profit to gross margin, 12.63. So this is where I ask the simple question. Which business do you want to be? Which business is better?
One with the least employees.
Yes. That may actually prove to be true, but there's a different answer as to why. Who else? What are your thoughts? Would it shock you if I told you don't have enough data to make the answer? So this is where everybody in the business world, you start here and you look at this and you become enamored with, 40 million. Oh, wait a minute, it's only 13% gross margin. No, but it is 1.2 million in profit. So they do make the most profit dollars, but it's kind of hard, isn't it? Well, and here's I won't go through this, but this is what I just told you in terms of those terms. So this will be in the slide deck that we'll share. I'll give you guys the slide deck after the session, and Bev will send it out to everybody in that process. And so essentially, what we've got to look at is get it to where you guys understand these differences. And I think I realized I actually put these slides in different order. So we'll get to that in just a second. So the key is, getting your P&L to speak truth. When you put it in this structure is our simple numbers P&L. So every client that we work with, this is what their P&L looks like. So we actually run mastermind groups now. So we have 2 of our own client mastermind groups. We've got 2 other groups that come together and ask us. We manage the data for all of them and put everybody's data in this format. And so we can now have a discussion with everybody in the group because we're using a common language of how that process works. If we took everybody's P&L here in this room right now, there's about 50, 60 people in here, you'd have 60 different versions of a P&L. Who came up with that idea? So this is my attempt at saying, listen guys, this is the only way to look at a P&L, in my opinion. Nobody's convinced me. I've been using this concept for over 10 years now, and so nobody's convinced me differently. that process. But it's up to you. You can put it in this format or not. But to us, this is getting it to speak truth. And then be careful of comparing to industry data. I was telling somebody before the session, I mean, industry data is so weak. I mean, when I see how it's put together, I mean, just be careful. You guys are in a powerful situation with forums. I mean, you guys can really get serious and look at detailed data. And I would encourage you to be open in your forum with the raw, honest truth. Now, we've done a lot of EO retreats for forums, and 50% of them that got booked never happened. And this is disturbing to me because about 8 of the 10 members wanted to do it, and 1 or 2 of the members didn't want to share their data. And I will tell you, that kind of, to me, violates the EO premise of trust and respect and transparency and integrity and all those things. So get over it. Your data doesn't matter, but it is a way to help each other. And you may feel ashamed of how little you make. Actually, you may be ashamed of how much you make and how much you waste. Get over it. I'm a big believer in data sharing, especially in careful, closed environments, which is what EO is designed for. So I think from that standpoint, this is a really powerful way to use this organization for what it can help you with, in that process. Okay, and so we talked about create a simplified view like this. Those templates are, if you go to the simplenumbers.me website, there's a free template that you can plug your data in that spreadsheet. I mean, it's nothing magical about it. It has the formulas already in it. The full cash flow model that we use, there's actually a blank version of it out there. So you guys have no excuse, because I met a accelerator member out in Tahoe. I went out and did an event, and this kid I'd never talked to, never done any work with. He had taken the free version of the model that's on the website, downloaded it, and perfectly mimicked it with his own data. He's like, I was so proud. Because, now granted, there's things that you can do, there's things that you should do, but there should be no barrier to that process, because it is there if you're willing to go do it. Now, some of you got better things to do, you can get somebody to help you, in that process. But the key is there's no excuse, in that. So if you're financially constrained, and this kid was actually pretty profitable. He's actually already an EO member now. But he was constrained at the time, so he wanted to do it himself, and he learned a lot from it in that process. So there's no excuse. And the other thing here is, as I say, think model, not report. Your financial data is a starting point to say, here's what it is, but what can I make it if I do something different? That it's not just a static presentation of financial information. It is, what can I do with it? Yes, sir.
So that kind of leads into what I was going to ask you. How often are you running this report, this model?
For our clients, we run it every month.
Okay.
Yeah. I mean, there's certain businesses. So, like we've got a really good lawn care client in Austin, Texas. That, his operating expenses are going to be what they are. They're no mystery. His is about weekly gross margin and direct labor production. And so he's on a 52-week, he knows his LER for the company and by team and by location every week for the last 52 weeks, the last 13 weeks, the last 4 weeks, and then the weekly averages. And so that's when you know your revenue and direct labor, your gross margin and direct labor by week, you got a really powerful operating system at that point, because the operating expenses aren't where it's at. It's about managing that output of that engine in that process. So if you've got a business where you know that's the gold standard in that process. So we talked about these. Compare yourself. So we talked about compare yourself to similar models. If you're in the services business, compare yourself to other people who do stuff. If you're in the manufacturing, compare yourself to other people who manufacture stuff. And if you're in the selling business, compare yourself to other sales organizations. And I don't think you learn too much with the industry stuff. And then this thing we'll talk about, isolating expenses that is for future years, the launch capital concept. We'll show you that. And so you create up a rolled up view, focus on isolation of labor, and then remove distortions. So that's the sequence that we're trying to get you to. Is if you look, and I'll show you this in a report here in a second, but so it goes back into psychology. The first data you look at is going to have the greatest impact to what you think. So the first rule of thumb of data is never, ever, ever look at monthly data first. You must always look at rolling 12 or rolling 52-week data first. That's financial truth. That is what your business has done in a 12-month cycle of what has happened. It's got all 12 months, all 4 seasons, all the holidays, every dog ate my homework excuse, in it. And that's the truth number. And then I'm going to look at rolling 3s, then I'm going to look at monthly. Monthlies always last. And there's studies in behavioral psychology about if you look at monthly data first, that's going to affect, you can't get away from what you saw, in that process. And then obviously the key we believe is on labor, and then removing the distortions. What are the things that shouldn't be in there that, let's be clear about it. So back to our example. So as we talked about this. So how many people, before I'd show you the data that you don't have, how many people would choose the manufacturing business? Not many. Okay. How many people would choose the selling business? Well, you guys, nobody's picking anybody. Anybody want to be in you guys don't want to be in. Yeah, that is the right. But just with this data, which one would you choose? So pick one of the 3. If you had to pick,
We already picked.
What?
We already picked.
You already picked? Yeah. All right, so here's the relevant information. So here's your profit number for each one as a percent of revenue. So in the manufacturing business, it's about this concept we call trade capital. So once again, they lied to us in accounting school. They came up with this crazy term called working capital, which every banker in the world talks about. And it's the dumbest measure I've come to believe of anything that they've ever come up with, because it's just wrong. It's wrong. And why is it wrong? Because it includes 2 things that are choices, cash and debt. They shouldn't be in there. And this was the big blinding light that said, aha, that's why this has been a stupid number all my life and I didn't know it. So I take out cash and debt. Trade capital is the stuff that turns over in business depending on the industry that you have. Now you can affect it, but you can't eliminate it in most industries. You have to really work hard to be totally different in an industry, and you possibly can, but these are forces of industry. So the manufacturing business has to give their customers terms. They have to carry inventory. They get inventory support in this particular example from their customers of the same. So essentially it's almost like consignment. Here's the number that everybody needs to know. Net trade, it's not about each one of these individual items. You can go beat up DSO, day sales outstanding on AR all you want. And it's like weeds in the garden. I can get my DSO from 40 down to 35 or to 30. Does it stay there? No. It grows back. It's a weed. So the idea, it kind of is what it is. So it's the net. It's the net of these numbers that matter. And we make it hard on you as accountants because half of this stuff is on the asset side and half of it's over here on the liability side and it's disconnected. And you don't see it. If we were building a better balance sheet, it would be linear and it would start at the top with trade capital. How much do we have in trade capital? They have $542,000 of their money that they had to invest to turn over $4.4 million of revenue a year. So that's 12.3%. Infrastructure capital of their fixed assets, net book value of fixed assets minus any debt directly associated with it, their net number was $250. And then the buffer capital, which is the core capital target of 2 months of cash, this particular business needed $317,000 of cash to be fully capitalized. So I don't care how much cash they have, this is the amount of cash they should have. Yes, sir.
What's deferred revenue?
Deferred revenue is when I've collected money that I haven't earned yet. Right. Yeah. Not retained earnings. This is where I build, customer has paid me in advance. It's like a deposit, exactly. It'd be the same customer deposits, deferred revenue, same thing. Okay? So this net number. So why does this number matter? The 12.3%. Because if my net income number is 13% of revenue and my trade capital is 12.3, that tells me that I'm in the cash flow free growth zone. This business can grow and not burn any cash, because as long as their trade capital stays at a percentage of revenue below their profit percentage, they will 100% self-fund their growth. That's what matters. So their growth is purely execution. Go sell it. Go do it. Maintain your profitability. Now, if that profitability drops to 5 and this stays at 12.3, guess who chews cash when you grow? That's not good. This is the most important relationship you can draw in understanding the cash flow and profit connection in your business model, is right here. But we don't present it that way. Well, we do, but traditional financial presentation does not present this. So what I do is, in our model, we now have a monthly balance sheet. So in between the assets and liabilities section is we draw a net number and a percent of revenue of these items. And so, like I said, essentially it's current assets minus current liabilities, but you exclude cash and you exclude debt that's in current liabilities. That's all you get to that number. And that is a powerful thing to know in that process. Okay? Now, here's what that business should have at full capitalization of invested capital, $1,110,000. $585,000 of profit to $1,110,000 is 53%. They meet the 50% standard. So that's good. So let's talk about the sales business. $1,241,000, 3.1% profit. This is how, and this guy is just an incredible business guy. This business was in the 20 million or so range of revenue. He had a bunch of partners, bought them all out, then went to his vendors and he said, listen guys, if you'll just give me 60 to 70 day terms instead of 30, I can sell 10 times as much. And they were willing to give him a chance to prove it, and he did. And so essentially, it's his AR and his inventory is basically covered by his vendors. But this business turns that stuff like crazy. Basically, the stuff that's sold on Amazon. But he does it in a very, very good way. But he's at a 57% return on invested capital. If he loses this vendor support, that's not a 57% return on invested capital business. That's why it matters. He has to get this piece to make it work. Because the other pieces you probably can't change in that process. And then the services business, you can see the only thing that makes that services business just eke into the 50% return is because they have $1,095,000 of deferred revenue, which means they've figured out a way to bill some in advance. If that deferred revenue went away and they had to carry more in AR, that would be a very dreadful business. And to a certain degree, services businesses fall into that category more often. I would say more of the services businesses are the ones that when we find them, they're below the 50% return until we teach them this concept. And then it gives them the backbone to go demand better terms if you're going to do work with them. And when you can get paid faster, because really in the sense of like a services business, see, they have no vendors to support them. There's nothing, they don't, it's labor. There's no vendor support. This guy in the selling business, he has a lot of vendor support because he sells stuff. and you only have a little bit of cost of goods sold in the manufacturing business, so they don't have a whole lot of room there. So they've got to make theirs up. This is the reason why these guys have to have 13% profit. See, that's if I'm below, once I can't change anything else in the capital matrix, the only number left to push is profitability. I got to get that profit number up to where I'm a 50% or better number in that process. But remember what I showed you in terms of the 50 company data set. The averages are 75 to 100%. So it's doable. Okay? Questions? Does this make sense? Can you go back and do this with your own balance sheet and P&L? With these slides. You don't have to do it from memory, but I'll give you the slides. Okay?
You coming with me?
For a fee. So the idea is if I'm going to build a better balance sheet, it's going to be 3 buckets. Trade capital, what's my AR, inventory, work in progress, minus accounts payable, accrued expenses, deferred revenue. Then what's my infrastructure capital? So I'll give you a good story. So the EO member in Omaha that I don't do his books, but he's a legendary entrepreneur in that city. He's got some transmission service centers. So he had 15 service centers. And I said, Pete, I'm going to use you as an example for the group. I was doing an accelerator class for them. And I said, Pete, I'm going to use you as an example. Let's see how close I get. So you're thinking about opening your 16th store. So here's the decision process. It's going to cost you about $1 million for the dirt and put up a metal building. He goes, yeah, that's exactly our budget. It's good. All right, I have my 1 for 1. All right, so that means the bank's going to finance $800,000. You got to put $200,000 of your capital into it as your down payment. So that's capital. He says, yep, that's exactly how we finance it. So it's perfect. Now, you're going to have about $200,000 of opening cost and losses to fund until that store breaks even. He paused and he says, yeah, that's exactly the number we use. That's good. All right, so we got $400,000 of capital input. Your go, no-go decision on the 16th store is, can you find a location that you believe that can produce $200,000 minimum store profit for that to recover a 50% or better return on that investment, and do it within and be to a $16,667 a month profit by the 12th to the 24th month of operation at that. He paused and he said, well, it's interesting because what you just told me in 2 minutes took me 30 years to figure out. And that's exactly his formula. Now, the value end, you got to find the piece of property. You got to go execute. You got to do something the market needs. You got to do all those things. But the finance part should never, ever again be a mystery to you, because that's how it works. I mean, actually, he's higher than 50% return. He's probably closer to 100, in that store. But that's exactly the buildup, of what that needs. And then this other piece I call launch capital, the magic pixie dust of business growth. That's that thing that hides on your P&L that we got to find a different way to tag, isolate, and report on and hold it accountable to being effective. Because essentially, this is the piece that means that you guys are all running legal gambling establishments. That's what launch capital is. It's legalized gambling. Some of you are good at it, and some of you suck. Most of you suck. And the thing is I want you to suck less, because we've proven that when we isolate it and account for it, you're going to make better decisions. It's just intuitive, in that process. But right now, you're not isolating it, you're not accounting for it. So therefore, you're going to make more random choices that are not fact-based. So here's an example of the balance sheet in this trade capital calculation. This is a different business. And so essentially, these are actually some sales distributorships. So check this out. So this company, sample company A, they actually have a minus 2.45% trade capital. So they have total total trade capital. So I've excluded cash and I've excluded line of credit, excluded credit cards and line of credit, which they didn't have. And so there's their net numbers. They're basically using $489,000 of their customers' money to run their business. That's a pretty good gig. So let's try to have more than that. This other business, they were actually at 9%. So they were actually even better. And so essentially, that's all you've got to do is just use your balance sheet to do those calculations. So that, and then hold that as a percentage compared to your profitability. And if trade capital is above profit, you got a cash problem that you got to figure out. So in our belief, the first thing, if my trade capital percentage is above my profit, I'm probably going to look at profit first to look at that and say, can I get is that just because I'm not focused? So now I've got a greater sense of purpose to hit a higher profit number. But if I can't change profitability, I got to attack the capital piece. I got to get customers to pay me faster. I got to get vendors to give me more support. I got to carry less inventory or carry the right inventory and all of those things. And then this would be an exercise if we had a longer time frame, in this, so you guys can kind of go through, this process. So we'll get back to that. Buffer capital, we talked about that. That's a 2 months core capital target number. Realistically, so going back to this, here's the numbers how you calculate it. So you take your direct labor, take your operating expenses. So here's 1 month core capital. Here's 2 months. Notice the difference in terms of type of business. The least amount of core capital needed is a manufacturing business that doesn't use as much labor and has some cost of goods sold. They have the least amount of cash required. The sales business, which is obviously much bigger, it requires a good bit more, but still not a bad number, but it's still got enough because of its size. But the worst one probably relative to revenue is the services business because you're an all labor business. So I got news for you. Any of you in the service business that are deploying labor, one of the challenges you got to overcome is trade capital or your core capital target because you've got to have a lot of cash in your business. And I struggle to get our services businesses to carry more than 1 month of core capital, but I still believe in 2 in that process. So idea being if you achieve 2 months of cash, 0 on line of credit, you should target a minimum 50% return. The only times that this formula has failed is in developing countries. We do not have an appreciation we should kiss the ground that we live on of the speed of cash as it moves through our economic system. When I did the tour in East Africa and the Middle East, the terms to grow a business bigger than the terms that you have to give are just awful. And so many of those businesses that I did a few breakdowns of were probably the same business here that we could get easily 50% or better returns on. They were probably at best getting 35%. And that's one, we could change third world economies overnight with better trade terms. That's the biggest barrier to capital in emerging economies is lack of trust in that process. Okay? So here's these are exercises, like I said, that you can go back and do. Infrastructure capital, just a quick note on that. Like I said, it's the net book value. So remember what I said about Pete's business. He bought a piece of land for $1 million. Why did I not count the million as capital? Because he financed $800,000. The capital is the piece you have to put in. So here's kind of our working things of the way we use any equipment. I want to operationalize the deployment of equipment or real estate. So if you deploy real estate in your business for any reason, I want to turn it into the equivalent of rent at a 15% return on investment for the owner of the real estate. So that's why we want you to own the real estate outside the economic business. And you should charge rent that gets you a 15% cash on cash return of that investment. And the same thing with equipment. I don't want you using your working capital buying equipment that can be financed. Just don't buy equipment that you don't need. Don't make it sloppy from that standpoint. But to me, there's not really a reason. I mean, other than you have idle cash that you want to get an interest return on, that's fine, But I'm not a huge fan of chewing up your cash, buying equipment that could be easily financed in that way. Okay, go back to using depreciation for what it was originally considered for, and don't use tax depreciation as your number in your books. And then we have an exercise here for that. So essentially, look at it like this in terms of the shading might be a little hard to see. The yellow is buffer capital, so that's the net number here. This is the simplified balance sheet right here. Trade capital plus infrastructure capital plus buffer capital. I have some other non-business assets that are trash in the business that don't need to be there. These other assets and due from shareholder, those are things that are non-operational in the business and it's just accounting entries that got stuck there and need to be gone. And so this is the clean balance sheet if you were really doing it the correct way, in my opinion. So I think Pacquioli had it wrong back in the 1400s, when he created the process. And we just allowed it to promulgate itself. Okay. So calculating return on invested capital. This is how in our models I calculate it. I show you your trade capital, I show you your infrastructure capital net of debt. Your buffer capital, what it should be, not what it is. I'm going to tell you what the gap is if there is a gap. And that's the number that I'm constantly displaying to you saying, are you at 50% or better? Yes, sir.
So this would apply in an acquisition, I assume. But initially, obviously, the acquisition is already hopefully running around 50% or more.
So
putting more capital in, which
no,
drive that down.
No. So here's the thing you need to understand about acquisitions. So one, I'm stripping out the acquisition elements of this because think about it like this. If I buy a business for 5 times EBITDA, what's my return on invested capital? 20%. So I've violated the 50% standard. No, I actually haven't because the idea is what I paid for it is irrelevant to these things. That's buying that paying 5 times EBITDA is what I bought and gave away to the selling shareholders. This number remains no matter what the buyer paid. I can always evaluate this piece. And then this becomes really the engine that the money guys ought to be paying attention to. So here's the math.
It's kind of like in your experience, what's that time frame to ramp back to 50 that you should be looking at? Is it 3 years? Is it 5 years? Is it?
So if you buy a business right today, to buy a decent business, you're going to pay 10 times EBITDA, probably. So that's a 10% inherent rate of return. Why would somebody pay 10%? Because I can grow it faster and better than you can, or at least I believe it can. So if I quadruple the size of the business, I get back to about 45% return on invested capital for the overall piece. And it takes about a quadrupling of the size of the business to make it work. And you pick the time frame of how patient you are as an investor in that process. But that's why they do it. 90% of them fail. This is a sad statistic. Of my clients who've either bought businesses or my clients who've been bought by, 1 out of 10 does the buyer get a positive return. 1 out of 10. That money's stupid. Yeah.
But to equate your transmission guy that
Yep.
had to get back to the profitability in a 2-year scenario to get his ROI.
Yep.
Would you not do that same type of calculation when you're hiring a sales person?
Absolutely.
In your business and then doing that calculation and all those type of expansionary thought processes?
Absolutely. Yeah, and hold that thought because you'll see an example of that. We use marketing money, but it doesn't matter if it's marketing or people, but it is absolutely 100% what you're saying. Absolutely true. Okay?
Question?
Yeah.
Why only 1 out of 10 succeeds?
Because money's stupid.
So
They're overpaying. They're desperate. They don't know. Here's the thing.
10 times EBITDA is too much.
Sometimes it is. I mean, my client who sold for 10 times EBITDA that had the product company, the company that bought him did better. They're one of the 1 in 10 that did better. You know,
How does private equity survive?
because it's capital. So here's the thing you got to understand. So so when we get into economic problems, it's because of leverage. It's using other people's money, our deposits that banks loaned that they failed at. Capital is not bread and milk money. Capital can afford to be lost. This is why we can afford for businesses to miss in this environment with these guys deploying capital, because nobody's needing it to put groceries on the table next week. It's capital. It's risky. It can afford the risk. But the 1 out of 10 is so valuable, it overcomes the 9 misses. And that, now, it's not as crazy as the dot-com days, but I will tell you, it's still better businesses that truly, we were driving the economy with just dumb stuff, back in the dot-com. Everybody that really succeeds in this, I mean, it actually ultimately becomes a real business.
Common sense tells me that it's not priced right.
It can be on either end of that equation. Yes, ma'am.
So just as an aside, it may be more than one factor.
Yeah.
In our experience with our clients and the acquisitions they've made, or that we see going on out there, it had nothing to do with the books. It had to do with the fact that there was a culture mismatch between the merger and the acquisition.
And that is an environmental issue. You're correct. And so, but those are things that cause those misses, all the time. And so, could it have been corrected with different strategy or different execution?
Nobody does this kind of due diligence.
Right.
Well, nobody except maybe us. Nobody
Yeah.
does this
Yeah.
due diligence on the people part of the business when
Yeah.
they're looking at a merger or acquisition.
Right. But I will tell you that here's the other thing, though. They actually don't do this piece that they ought to do to actually quantify what really needs to happen to say, am I asking too much for what I'm buying? Is that actually feasible? Yes.
Yeah, one factor you didn't mention is ownership's relationship with the customer. I know what she's talking about.
Yeah, I mean, certainly if.
Harvest to
Yeah, certainly if you want to build a harvest to premium sale, you've got to make your personality less relevant to the business model. You got to take your persona out of it, if at all possible. So, okay, all right, so let's move on. And then we've got the exercise on return on invested capital. So I want to, all right, so let me get to the launch capital piece, because I'm telling you, I think this is really where we got excited with this, that we were able to isolate. Because the idea is, you're going to identify any initial spend that will be the catalyst. So I'm not talking about reflection costs. If I add a person to grow the business, I do not need to get caught up in payroll taxes. Am I going to have to buy them a desk? And I'm going to have to buy a software license? It's noise. Look at the catalyst. What is that initial decision? Because the payroll taxes go away if I turn it off. The desk, I am probably selling on Craigslist, but the idea is stick to the things that are easily focused on as the catalytic choice spend that nobody's making me spend. I'm making it by choice. And then, how much will I lose in this process until I break even? So it's like in Pete's case, I said, it's your opening expenses plus operating losses until that location breaks even. That's a someone's got to fund that. That's a capital cost that I got to fund. So I got to add those in there. And then I got to establish this expectation of what is profit going to increase. So like when we use marketing, the next marketing person that starts to talking to you about marketing yield based on revenue, just shoot them. Because that's not, it's about, did profit go up based on marketing spend? That's the harshest measure you can use to say, did we succeed? They can give you, here's your yield on leads. Okay, that's an interesting piece of data, but that's not the finality of it. I'm a bottom line guy. Give me the profit. What did profit change in that process? And that's going to be, I got to get a 50% return within 12 to 24 months. There's a handful of businesses that'll be outside of that. Guess what that is? High stakes gambling. Not mean that you won't do it, but it's going to be the exception rather than the rule. But if that's what your business is like, that it takes more than 24 months to know if this investment works, God bless you. Yeah.
Now is that a 50% return on capital at that month stage? So
Yes.
in 24
Right.
months, I put in 200 grand.
Right.
Now I'm getting 100 grand.
Right.
According to the cash flow that's going to drop.
Yeah, so like I said, in Pete's case, he needed a $200,000 profit number for $400,000 invested. So that's $16,667 of profit that month. So that first month that he clicks that number and is that number or higher, he's there. And that happened within 12 to 24 months. Okay? So, example. So this was the software guys that I was telling you about. And this is really kind of where the noodling process started of this research. It's just that thing that bugs you about looking at the data going, there's got to be an answer to this. And so these guys were running their business at close to zero. You can see, basically making money and losing money roughly equal to the number. And so starting back in about 2014, I would sit down with these guys at the end of each year and say, hey, what did you spend that didn't do anything? And we started extracting these things, and it was two things. It was extra spend in tech dev and extra spend in sales growth initiative. And literally, these were the amounts that they spent that produced zero benefit. And they admitted it. And so they truly, in this particular year, they would have made $1.1 million of profit had they not spent that money that produced nothing and never produced anything. Now, I don't feel bad for them. And they wasted about $4 to $5 million of their profit before they sold, but they sold for $40 million. So they came out all right. So they're living the good life. But I look at that and I go, hey, $4 to $5 million is kind of a serious amount of money. So can we avoid not spending that? If we spend it, let's make it more strategic and more effective in that process. So that was the first start of this. So this is a client of ours that we started. So those of you that are accelerators in the room, I want you to notice, this was back in 2012. This guy was an accelerator when he started with us. $700,000 in revenue. So his belief was if we increase our marketing spend, so this is the catalyst right here. They're going to go from 75,000 marketing spend to add 121. And so in this case, we want to get a 50% return on this 121,000. So profit must go up by half of that number. So it must go up by 60,000. So a win would be profit for the next year of 124,000 or better. So that was the premise. And this is more traditional marketing, people on the road, trade shows. So it's irrelevant as to, I don't care if it's social media, whatever you spend. We've applied this in a lot of different cases, and it seems to resonate and come back to the same number. So we don't care if it's marketing or people or whatever, it's that same number. So the first year, what did he do? Well, he slightly missed it, so he got a 45% return. So he got profit to 118 instead of 124. So we go, okay. Now notice what happened. I mean, the business went from 703 to 2 million. Gross margin went down a bit. He had to add some direct labor. So direct labor efficiency is kind of pushing it a little bit, but not much. So everything he had to add, he added his marketing spend. He added a little bit in management labor. So those are all reactionary costs. And the reason why we didn't add them in the catalyst was in his particular scenario, he didn't have to add those costs until he knew he had the sales. So that was a huge advantage. So sometimes you don't know that. So if you don't know something, you got to add it before you know that you won. You have to count that in your catalytic cost in that process. Those are guesses at that point. But once he won the work, I'd have to add that to the 121. I'd have to add. You look down that whole column and say, which of these do I have to prospectively guess and pre-fund? So, I'm not I need to have more consultants and more tax preparers on the team. I'm not a huge fan of having them in advance. Now, actually, we're trying to hire both as aggressively as we can. But there again, I don't want one sitting around twiddling their thumbs waiting for us to find work for them. So in that case.
So to Andy's point earlier, if you're bringing on a salesperson, especially if it's a service business, it's rare that they're going to be productive immediately.
Yeah,
There's
absolutely.
Some ramp up. So is that a launch?
Absolutely. We do that. That's probably the most common calculation that we do for clients. Just tell them how long, and it comes into this thing, especially in salespeople. I'd be interested to get your take on this. So this is what I tell people when you hire salespeople. I said, this is going to take some time for them to be effective. But when you tell me that you've hired a salesperson, I'm going to put it on my calendar and call you in 30 days. I'm going to ask you a simple question. Are they going to make it? You know, I don't care if they've had time to sell anything. You know in 30 days if they're going to make it. And you need to call it right then. I have never had anybody tell me unequivocally, yes, they're going to make it after 30 days. There's always some, I don't know. As Scott Fritz, a famous EO member, once said, when there is any doubt, there is no doubt. And so if you're waffling in 30 days, you got to put it on a short clock there to move them on, because you're losing opportunity cost of the right person the longer you keep the wrong person there. That's an expensive cost. And that's a hard one. That is where you guys are going to earn your keep as entrepreneurs. But you got to make that ugly decision, and call it as soon as you can. Okay, so.
Can I add anything to that?
Yeah, sure.
I mean, in the sense that
Yeah.
profit out of those sales.
Absolutely. All right, so here's where we are, first year. So, okay, well, 45, we didn't quite hit 50, but all right, let's keep going. So they're going to add another 103,000 to marketing spend. And so now they got to get 51,000 of that, so we're going to be up to 170 as our profit target. So what did they do? They blow it out of the water, 493% return. They jumped to 628,000 in profit. 17% profit, 3.6 million of revenue, good margin. So this is, when you see labor efficiency, I can give you this. So notice what's happening here, 6.02, 6.8, 8.14. What do you think's happening in direct labor? It's a concept we call running hot. So you have to use this. This is where, this gives you a number to connect your gut and the numbers to your eyes. Am I stretching people in an unsustainable fashion? And so they're juiced a little bit of that profitability by probably not adding labor as fast as they probably should have. And you can get away with it for a little while, but you'll eventually have to catch up. But at the end of the day, anybody good for 493% return? I'm good. Now, so this is where the incredible skill and ability of an entrepreneur says, hey, if a little's good, a lot's got to be better. So we're going to light this puppy up, and we're going to add 394 to it. And so now we got to add 197. Oh, we can go from 628 to 825, no problem. What do you think happened? They missed it. They basically got their money back. But this is, especially in this black art called marketing, you're trying to find the edge of the universe, and nobody knows where it is. And some people take leaps, and some people take little baby steps, but you're trying to find the edge and not fall off and die in that process. And so they didn't quite die, but they found the edge. And the other thing that happens in this case, what was working stops working as well. Your message is never fresh forever. You got to change it up. You got to change some techniques. You got to try something new. You can't just be blind to this. So they learned some things. Give them credit. They took it on the chin, but they said, okay, we can fix this, and we still believe that we can grow by this. So they added 166 still, and targeted 701 in profit. They actually hit 769, so that was a 91% return. And then the next year, believed it again, added 154, needed to target 846. They actually got to 1.2 million, so that was a 286% return.
Greg, do you
Yep.
think part of the problem there was, if you look at their LER numbers,
Mm.
way up
Direct
and then way
LER.
back down,
Right.
do you think they just didn't invest enough in the staff to?
This staff was executional. That staff was not selling. So it's the management labor and their marketing spend that was what was driving that. But they did stretch their profitability here at a 10, and you can see they got back into 6.8, 6.9 is kind of their target LER now.
So
Yeah.
If it brought 10 new people through the door and they, I don't know what type of business it was, if they weren't just able to service them, could that have been?
It wasn't that. It was they just didn't get the customers because they wasted marketing money, and it's easy to do. You know, you can trade. Like I said, this was a little more traditional marketing, but I've got a client that does cruises, and I mean he's one of the best SEO guys and does his own for the most. He's got some people that helps him execute it, but he's the strategist, and he's probably one of the best guys that I've seen. But yet there's times that the market just throws you a curve, or Google changes an algorithm, or who knows? I mean, some of you probably felt those pains of somebody changing something that's outside of your realm of control. It's all kind of part of it. But essentially, look at this. This business went from $700,000 in revenue, and in 5 years went to $10 million. $10 million in revenue, and you know, and $1.2 million in net operating income. I mean, that's.
What kind of business was it?
This one is a sales business. Yeah. So, but there again, I mean, it's still that idea of what is that catalyst. And so, like, you know, they were talking about, what is your catalyst? All of you are going to have a different catalyst. Is it marketing? Is it people? You know, is it one of those things? But this is the technique. Traditional financial gathering. So what we've started doing, so we're still developing different ways that we track this. So like on an ongoing basis, our clients, we've got a client that's in the financial services industry, and so what we've started doing is we've got a sheet in our model that they tell us every month, what did you spend this month in operating expenses that were launch capital spend. And so we track it there so we can extract it and show them a clean net operating number without the trade capital cost. And say, this is what your normative business is doing. Now here's what of that profit you chose to use to invest to try to grow, and did it grow? And that way. So everybody's going to have a little different tack, you know, be able to do it. This is an operating business, a restaurant business. And so we were going over their data. You can see data is back in 2018. And so their profit went from 867, 731, and then down to 420. But what we knew is they were expanding their facility. And so they're kind of feeling bummed about profit being at 420. And I said, well, hold on there. You know, let's break this out. So this is how this is what I would call an extractive method of launch capital determination. So we're going to take this and say, now, so we've got the rolling 12, so we can see the problem here. So let's look at rolling threes. And what I can tell you is that in the rolling 3 data, and this is a restaurant that pretty consistent 12 months out of the year, so we don't have to deal with seasonality. So I looked at the rolling 3 and said, because we'd been after them for quite a few months to increase pricing because they'd had cost creep. And I'll tell you, you guys have to super be focused on price adjustment. And you got to create dynamic ways to change your prices. You can't just change prices once a year. You got to kind of tweak and adjust your prices on an ongoing basis, especially when you have labor costs that starts to creep into it. So you got to really pay attention to that. And so in this case, we looked at his rolling 12 and we realized in that month, the rolling 3 for September of 2018, they'd actually implemented their price increase in July 1st of that quarter. So what we saw there was this contribution margin percentage was to the best ever number, 59%. So they had fixed the engine part of the business by that. So I could live with that piece and know, okay, the engine is fine. Now let's look at the chassis. And so if we look at the chassis, we're going to do this. We're going to look, here's the rolling 3, And if I annualize the rolling 3, I'm running at 1.1 million instead of 760. So that's $339,000 of new facilities cost for the new facility that's not open yet. So I could isolate that cost. Same thing with marketing. There's about $78,000 of marketing spend that was a pre-spend for the launch that hadn't happened yet. They brought on additional labor for training of managers that weren't producing. They were there just observing and monitoring, so we could pull that piece out. They had a consultant that helped them on it. So the sum of their trade capital spending was $587,000. So when I re-look at their profitability, instead of $470,000 of profit, they were really at over $1 million. So this was their true net operating income on the business as it was running normatively. Now, we don't forget about the 587. I need a 50% return, so 50% of the 587 is 293. So their new profit target was $1,301,000 for the next year. You'll be happy to know they hit about $1.8 million. So they did pretty good. It was a good expansion. But that's how you make that happen. Because I've got to know, how is the business in its current state running? Is it sick or does it need fixing? And I need to know, am I going to get a good return, and what is now my new target based on this spend? To us, those are absolute have-tos. You can't guess anymore. If you're a good guesser, then good for that. And so, all right, so we got about 15 minutes. Let me see what I want to cover. Any particular questions while I look at my slide deck here right quick? Yep.
At the beginning, you spoke about challenging your clients to proper pay. I would assume that's W-2, because then you kind of went into the distributions and only taking those out after you got them to the bottom of everything else. Is there a rule of thumb on W-2 versus distributions because of the implications of all the taxes that are added on when you pay higher on W-2 for the others?
Taxes are a rounding error. You should always pay yourself a salary of the full market wage of what you'd pay somebody else to do the job that you're doing. I'm batting 1,000 on this. Every client that I've gotten to raise their salary to what they would pay someone to do their job, they have made more money in salary and the business became more profitable. Every time I get somebody to pay themselves a full market wage for their true value, they made more money in salary and the business became more profitable. You overcame that change because you will emotionally defend your salary more than you'll defend profit. Guaranteed. Yes, sir.
Go the other way with that same question. If you run into an owner who's overpaying himself, right? He needs the $300,000 or $400,000 or $500,000 to pay for his cars.
Same difference.
But do you add that back to normalize the numbers when you're doing this calculation?
Yeah. So we take if we can't get them to adjust to a correct number, we'll take that excess pay and put it down below the line as an other expense, so that they see net operating income in its true sense. And then they see that extra pay becomes a use of true profit. So that's how we deal with that one. But but there again, we've had people thought their business was underperforming. It's like, no, I mean you're dragging it down. You're not worth. I don't care how special you think you are. You're not worth that much. So. Well, that's a different. The loan to shareholder only happens when you don't have basis to take a distribution. And generally, if you don't have basis to take a distribution, you probably shouldn't be taking a distribution, period. Because I can't think of a time that you would be at full capitalization if you have a shareholder loan in that situation. You got to pay taxes to build capital. You guys, here's the thing you need to understand. You have a capital creation engine. It's called your business. It's called after-tax profit. I must pay taxes to create after-tax profit, to build equity, to build capital that I'm reinvesting back in the business. And all of you have capital generators right in your hands. Let's do it. Okay, so let's go through this because we got a little short time here. So as we say, a man who aims at nothing hits it with amazing accuracy. So to us, the key is, it's called targeting. So before you can do forecasting, you must establish, I believe, a target of what you're aiming at. What is the optimal picture of your business if it operated in its best capacity today with what you have? And what does that look like? And once I establish the target, then I can plot the monthly process of how do I get from here to there on a monthly basis. And then that tells you how long it's going to take. Is it a 3-month fix? Is it a 12-month fix? Is it a, never get there fix? And let's do something different for a living in that process. So rolling 12 data generally gives you a better, if you have rolling 12 data, you can do some trend forecasting a lot easier with that. Labor productivity certainly is the key to that, and then optimizing management labor relative to that labor productivity. So let's first talk about, the art of targeting in this. And so the idea is, traditionally when you're doing targeting, you're going to put a revenue number and you're going to work your way down to net income. We don't believe in that process because, you're not setting you're guessing at the revenue number, which could be wrong. And you tend to kind of make unfounded assessments of your cost structure. So what we would rather do is work from a bottom up. Identify management labor that's paid. What's the management LER number that you need? Identify the direct LER target that you need. And then you're basically working your way back. You're backing into gross margin. So we call it bottom up targeting. So let me actually skip this and get to the different example. Let me do this one. So this is a services business. Actually, this was an accelerator as well from many years ago. And so when I first found them, they were doing about $577 in revenue, and they told me that they were at 25% profit, but they were having cash flow problems. And I go, something's wrong here. So I got a hold of their data and realized they were actually at 4% profit because they were treating this owner compensation as distributions instead of salary. So I said, okay, we're going to fix this, so we're going to treat this as salary. Now, guys, this is an effective version of the P&L as you get because I've skinnied this up to where, notice what I have. Revenue, cost of goods sold, direct labor, 3 lines of input, 2 lines of input here. Owner compensation, call it management labor, everything else. So this is facilities, marketing, payroll taxes, other operating expenses. This actually works because in this example I'm going to show you, I never forecasted this number. It's just going to happen. It is what it is. It's about getting this number right and this number right. So here's what we said. All right, guys, first thing you have to do is prove to me that you're worth what you're being paid. So we're going to pay you $123,000. It's 2 guys, 50-50 owners. We had some insight to know that and it's like I told you on the senior in-home care, this 350, this is kind of in a smaller business, a minimum management labor efficiency ratio you want to aim for. Certainly I want to be better, but I don't see too many that are effective below 3.5. So it's a good starting point. So we said 3.5 times 123,000. So we need to be at 433 a contribution margin instead of 317. Okay, great. So what we work at from there. I will tell you, anybody in here a marketing agency? Any marketing? Yeah, so marketing, I will tell you that generally a good LER number for marketing agencies is about a 3. So take it or leave it, but 2.7 to 3 is kind of where we think you ought to be. So we use 3 for them, being small. And I said, all right, so this is the highest math I'm going to ask you to do. So remember back to algebra. Solve within the parentheses and work your way out. So contribution margin of 433 divided by direct LER of 3 minus 1, which is 2. So contribution margin divided by 2 is 216. Add those two together gets us to gross margin. Now, I don't really care about revenue. What I care about is gross margin. They can pass through all the work that they want. We got to have $649,000 of gross margin. And look at this. I mean, we actually targeted the exact same staff that they had. So this is clearly listen guys, you got the right people, you just not getting enough out of them. So can you produce roughly $8,000 more a month for the next year with the team that you got? Oh yeah, no problem. Good, well let's prove it. Well, what did they do? Well, they beat it by 10 grand. They got to 658, and notice what magically happens down here. So they got to 308 direct LER. Very good. Profit, oh, this number right here. After salaries, they made $134,000 profit. So about a 20% profit to revenue. Pretty good. I said, good job, you need a raise. So now believe that you actually know somewhat about what you're doing. So we're going to give you a raise. You're making about $103,000 a piece, $350,000. This rate stays the same. So same rates apply. So by raising their salaries about $75,000, ooh, that kind of jumps up there, doesn't it? So now you understand the power of leverage of labor. That number on top goes up really fast by adding labor. So you just better understand the relationship to it. So they go, okay, yeah, okay, we can do that. Okay, all right, cool. What'd they do? Well, they missed it. They got to $1,040,000 revenue, but they needed $1,088,000 in gross margin. So notice what happened. Freelancer, the cost of goods sold for them or outsourced work that they couldn't handle internally, so they outsourced more. So they outsourced 81 instead of 33. Why is that? Didn't hire enough. Well, I gave them a budget of 362 of direct labor, but they only spent 271. Why is that? They didn't hire enough, but why? What's the classic error in a growing business? Well, you know, but they knew that they needed to spend money. Well, they didn't start soon enough. You can't wait until you can't start looking the moment that you need somebody. If you are not trolling for talent every month, whether you need somebody or not, you are behind the curve. And this was several years ago. The labor market was better then than it is now. I mean, it's a challenge to hire somebody right now. So you better always be looking. And you find a good person, even if you don't have a slot, you hire them. And you know, and I put somebody else out on waivers. You know, so it's kind of, you know, there might be some quarterback from Auburn that might be looking for a job. You know, so just saying, you know, that, you know, there is this idea that, you know, the Panthers could trade up to get this kid from Alabama, you know, and we'll just see. He's got a bum hip, but he's pretty good. So anyway. So from that standpoint, they didn't start soon enough. But still, 352 direct LER. So interpret that number for me. Is that good or bad? The target was 3. Is high good? All right, split. It's good and bad. It's good economically. It's bad culturally. Because I'm stretching my people. I'm running hot. So that's one of the best indicators that LER can be for you is when are you running hot and when are you unfocused. And so that's telling them they're running hot, they didn't hire enough fast enough, and that's a false indicator of profitability, but still, $233,000 of profit is pretty good. So good job, you need a raise, and we'll fix these problems. So we're up to about $125,000 a piece, but same dollars apply. Now they got to hit $1,334,000. They've hopefully learned their lessons. They got a labor budget of $441,000. So what did they do? Well, they hit it. They actually spent slightly less, so they're at $326,000 of direct LER. Look at what they did in cost of goods. I mean, they outsourced. And this is the thing about sales. You can't easily target a sales number of precisely the number that you want. So you get sales going and they overshot it, but this is not all bad. I mean, they used a lever to let some of it out. Yep.
So if the results are the same at the bottom, and you know, what's the fundamental difference between an outsourced cost of goods sold employee, a 1099er who goes in COGS, and a W-2 employee that goes in direct labor?
A huge amount of margin. You're generally going to pay twice as much. In this particular industry, you're going to pay double an hourly rate for an outsourced person than you pay for an internal person. So generally the crossover point is if you can keep somebody 50% utilized, you're better off to have that resource internally than externally.
Sure, but you give them a budget and they spend 50 in one place instead of the other, and they still not.
They would have made probably another $75,000 of profit had they been able to service that 207 with even letting labor go up if they had served it internally. So to give you a good example, in the services industry, typically when you're you're servicing contracted labor and they're not your employees, your LER, your direct LER on those people are about $1.40-ish and maybe to $1.50, but they're getting a 3 multiplier on their employees. And so the margin differential is huge.
Is there an opportunity, or is there an instance where you would say, okay, there's not a difference? I'm thinking, my employees are making $30 to $50 an hour.
There's always a difference.
Right, but a 1099er who's an independent comes to me and says, I want to be paid 1099.
I cannot think of we have plenty of those situations, and I've got some examples of those. But in every case where it's a independent contractor, they cost me more and I make less margin off of them. And culturally, I don't like them.
Always.
Yeah. What?
Always.
Always, yes. I try to not ever use absolutes, but I don't have a case where it's otherwise. So, hey, if you can find a way to make it happen, I don't really care.
But there's always an exception to every rule. So.
There's always an.
In today's environment,
But I can only tell you my personal experience, and I get to see a lot of data, so I haven't had one yet. So, yes, sir.
Along the same lines, like we've had other speakers in the audience come in here and said, outsourcing labor is a better way to do it for a lot of tasks. So what are your thoughts on that?
I don't really care. You're trying to get to the best solution at the least cost. So to me, it's not a question of outsourcing or insourcing. What gets me, if it's a production role, if that outsourcing is from revenue to contribution margin, what gets me the most margin dollars is what I care about. It's not a rate, but the rate is an indication. But I want the most contribution margin dollars one way or the other. But if it's down here, I would say like accounting services, our industry's been one of the most that, the amount of people that you need on staff to do accounting internally has shrunk and shrunk and shrunk. And one of the reasons why our accounting solution team has grown so much is we do a handful of outsourced bookkeeping jobs, but we try to avoid them. But our biggest demand is for what we call an accounting manager to go in and do a month-end close, looking over your admin or your non-accountant person who's doing the data entry. And I will tell you, if for data management, your goal is to take accountants out of the process of your data management. That's what you should be striving to do. What you want to do is embed accounting into the operational process of things. Get the accounting data being touched by the people who have the most knowledge of the details of the transaction, not handed over to somebody else that has limited knowledge of what that transaction is. So the kid behind the counter at McDonald's, he's doing accounting whether you realized it or not. When he presses that picture of the Happy Meal, it figures out the cost of goods sold, the labor cost, and tells them how much change to give you back if you happen to be one of the 1 out of 1 million people that gave them cash, and said, because they don't know how to make change. And so you got to tell them. You might, now it probably, to be quite honest, it might tell them actually how many dollars, nickels, and ones, that they need to give back to if you look on the screen.
Greg, when you make the comparison for the 1099 on the employee, fully loaded costs like payroll and cost to manage that employee, and because my question would be like, why would Lyft and Uber, the size they are, use outsourced employees?
Abuse of their staff.
That's how you see it.
Yeah, absolutely. Absolutely, yeah. I'm telling you guys, payroll, if you think payroll is a burden, you're living in the 30 years ago. There's software that handles it. It's not a big deal. You get into more problems trying to stay away from payroll than you will ever get into by treating them as payroll. All of you are probably non-compliant with the current labor rules. Got news for you.
Well, I have both
Yeah,
employees.
yeah.
My business is
But you have employees. But hey, did you guys realize that we had a change in the overtime rules 2 weeks ago? You may not be compliant just because you have employees. So you better pay attention to those things. So anyway, I don't want to get down a rabbit hole because we're really at time here. So essentially, this is this targeting process. So let me show you one more here of this example. So this is a launch capital example that most of you are in. So this would go back to the manufacturing company So they're at 4.4 million. They're trying to emerge out of the black hole. And they say, hey, what we need is a good COO. So this is the labor example. So we're going to add a $150,000 labor piece here. So now, this is a singular retargeting. So this is not a 1 month, but this is where they need to aim at and see how long it takes them to get there. So I'm just adding 150 to management labor to get to 600. So I'm basically keeping all of the rates of everything the same. So management labor efficiency stays the same, direct labor efficiency stays the same. And by adding 150 to management labor, I now have to hit $2.2 million of contribution margin instead of 1.7. All right, so that's great. So now, let's see, I got to add 300,000 to direct labor. How many of you would have thought by adding a $150,000 salary person to management labor that I got to go hire $300,000 of direct labor to support that? Not many of you, some of you would. But, okay, so when we get to there, so that means we got to get to 3.4 million of gross margin, which means we got to back into 5.8 million of revenue. By adding $150,000 of management labor, I need to grow the business by $1.5 million. It's a 10 to 1. We do this build-up calculation every model with a client. You're a low of a 6 to a high of a 10.
And this is where the other people that have come to talk to us have said it's that line that you outsource, so you don't get hit with 150 if you don't need the full 150.
There's wrong. I mean, whether you outsource it or not is irrelevant. Labor's labor. Tell me what happens without labor. Does any of you have anything in business that happens without either direct labor or management labor?
But if that's number 75, then the direct labor then only needs to be 150, right?
I think the
Well,
challenging part is you would need a full-time CFO with that.
yeah, this is a COO example.
Or a
Yeah,
COO.
right.
A lot of businesses aren't at that size, and that's why you
So-
outsource this stuff.
So I use this as an example though. This is what I call the first stage of entrepreneurial mitosis. So at this particular point, you're a single cell amoeba of you are the CEO, you are the CFO, you are the COO, you're the head of sales and marketing. And the first stage of entrepreneurial mitosis is you have to give up either operations or sales and marketing. Pick one of the two. Our data, we did a study of 134 of our consulting clients. Our data said unequivocally that you have a higher probability of being a growing profitably business if you as the CEO own the sales and marketing function and give up operations. You will become a profitably stable business at best if you are an operationally focused CEO. Now, that's just empirical observation, take it for what it's worth, but we looked at 134 companies, and the screaming evidence of the difference between a growing profitable business versus a profitably stable business is the CEO's focus on sales and marketing. Doesn't mean you do it, but it means you own it. That's the difference. But that's huge in that process. And so take it for what you believe. But it doesn't matter if you outsource or insource or whatever. I'm telling you, for every dollar of management labor that you add, whether it's fractional or whether it's full body, it's going to just use 8 to a 10 multiplier in terms of what you got to go get in revenue. Now, if you're a low margin business like that sales business that had a 13% gross margin, his multiplier is 26. So just understand if your margin is below, say, 30% gross margin, you're going to have an even bigger multiplier in terms of the revenue number. But we do this calculation every day, and it's a low of 6 to a high of a 10. Use 10 as a good estimate of saying, because if I don't believe that this person is going to get me to $5.8 million, I am not doing that hire. I have the wrong guy. And that's the part that you got to quantify. And if you quantify it, I believe you will have a better probability of making a better decision. That's my premise.
Do you run that same number for like a sales manager?
Oh, it doesn't matter. I mean, if you're in this bucket, your multiplier effect is, it doesn't matter what the I mean, this could be, I mean, you could add that for an administrative assistant. Yeah, they all count. You know, direct labor, you're just multiplying off of the direct LER, you know, number of what you need to get for them. But that manager, this is the thing that we've been missing, or one of the things we've been missing is understanding this leverage of management and holding management accountable to results. Otherwise, I got the wrong management.
Your comp plan should be built off those factors.
I'm sorry?
Your comp plan should be built off those factors.
Oh, absolutely. Guess what we do, all of our variable comp plans that we do for bonuses, guess what number we use as the critical number? Nope. Contribution margin. This line, contribution margin, is the most important line in your P&L. That's where it happens. It splits the P&L in terms of where your issues are. If that number is too low, then I got to look at, okay, can I change operating expenses to better align to what it is, or am I not challenging my engine enough to get the productivity? Do I have the wrong producers?
How do you single somebody out though? That's one bucket.
So that is the unfortunate thing we don't have time for, so that's what we call the profit cube. So to the point that I can do segment analysis of revenue down to contribution margin. So generally what we want to do when we do segment analysis is we're looking at revenue to contribution margin for the company in total, by division, by line of business, by customer, by team, or by person. I know it by person. I literally know LER by every direct labor person on my team. I know it for our 4 divisions of consulting, tax, accounting solutions, and opinion financial statements. And I know it for every person on that team. So there's no mystery as to who needs to step up and who's got to work on their improvement. Now, once again, this goes back to process structure. Are you tagging the data to be able to produce that information? So those of you that can do time tracking, we work with a lot of managed service provider companies. They have wonderful software that they horribly use. And it's like, listen guys, you got the greatest tools since the invention of fire, but you're not holding your people accountable to put their time in accurately so that we can get the analysis. But the data's there, but your data's crap because you're not holding people accountable to time entry. And I'm a huge fan of time entry. I hate it. I've had to put time in for 33 years. Actually more than that, 39 years. But it's necessary in a services environment to track it. And that's where your data systems have to be tagging. I don't really need to tag much down here. But I definitely need to tag revenue, cost of sales, and direct labor for every production of margin that exists. Okay, all right.